So capital formation in the in blockchain and the cryptocurrency space, and sort of trying to address a little bit Jersey's position in financial services. It was interesting what struck me in Chris's talk, though. Anyone that's read The Innovator's Dilemma will know that pretty much all the incumbents from a given phase of an industry are gone when the next industry evolves or emerges. So the risk for Jersey in this new form of capital formation, whether you call it cryptocurrency or tokenization or whatever, is that in trying not to be the first or near the front, Jersey does risk not really being involved in that process at all, and other people are leading in that space. So I don't think that necessarily being conservative is waiting 2 or 3 years and to see how things emerge. This is just a little bit of background about, we think that there are strong parallels between the emergence of blockchain as a technology and the emergence of the internet. The difference is that when the internet emerged, the protocols that underpinned it were all basically open source. Now there's a lot more value being created at the protocol layer, and that makes sort of a big difference to the landscape, we think. I'm going to have to sort of run through these because I think that I'm basically going to get dragged off the stage at minute 15. So I just want to kind of give people a bit of an overview of blockchain use cases. Everybody knows about store of value, thinking of Bitcoin as digital gold or whatever, as a global payment network, and then the distributed ledger elements that Dave kind of touched on to some extent in his introduction, which probably has tremendous scope for value creation. So this is what we think has been going on. It's a classic kind of story about the evolution of any financial market. Bitcoin hit 20K at the end of 2017, and we got down to sort of 6K recently. So in that space, there has been a lot of money raised by in tokenizations and ICOs. Many of those projects are actually doing interesting things, but now they have raised the money. They've got to go hire programmers and build stuff. So we've gone into this kind of gray phase where it doesn't feel like there's very much going on, at least not above the surface, but below the surface, there's a tremendous amount of value being potentially created. Some of it will be rubbish that never gets used, but some of it is really interesting technology. But there's no news, and so investors get disenchanted, they start throwing their coins out. You're seeing exactly the same thing in the precious metal space. People discover a new gold deposit, and then it takes 6 years to build the mine. In that phase, investors just start dumping their stock. And then institutions start to buy into the space because they see real product, real protocols, real transformational stuff going on. And I think that's going to take 2, 3, 5 years, but there will be pockets of value created before that. Just a little refresher on everybody's favorite stock right now. Amazon has been an amazing company, and if you look at the way that it evolved its business model and has emerged as a sort of global dominant player in so many different market conditions. But way back in sort of 1999, 2000, it did have a little mini bubble of its own, but that now just looks like a very small bump in the long-term chart. And I kind of think that that's very plausible kind of, where am I supposed to be pointing this to actually make it work? Okay, so when you zoom in on that little bit, it took 7 years for Amazon to get back to its high. And in that phase, I'll bet there were lots of people that said it was game over for Amazon, and it was just another mugging. I mean, there were many, many muggings of investors in that sort of 99, 2000 internet bubble, and it's been exactly the same in the crypto space. One of the issues with the tokenizations and the ICOs, which again strongly paralleled in early internet, is that there's very little correlation between the sort of metrics or measures that you can put on usage or of a particular blockchain and value of that blockchain. In the old days it was eyeballs and things like that, which turned out not to be very good metrics, and today it can be transaction processing throughput or whatever. Volatility is massive, so you're getting people thrown out of positions all the time because of they get margined out or whatever. And some of these projects are crazily over-speculated, and it gives people a false sense of the value of their own projects. But there is still some interesting stuff going on. Okay, now I know where to point it. So this is interesting because this puts the amount of capital that's being sort of raised in the ICO space into perspective against the more traditional sort of asset raising areas that Jersey would be more familiar with, handling IPOs or venture capital investment and private equity funds and so forth. And it's starting to be a significant amount of money relative to those markets. So it's something that Jersey as a jurisdiction in financial services, should not ignore. And I think it's unlikely that is going to reverse. I slightly disagree with Chris in terms of something he said about the quality of ICOs that we're seeing coming out. There's still plenty of shitcoins. If anything, it's getting harder and harder to find really good technology projects because there are just so many shitcoins. Again, putting it in perspective, you can see here that ICO capital formation, approximately the same order of magnitude as what we're seeing in IPOs and venture capital. One of the great things about ICOs, and something that other forms of capital formation should be learning from, is how quickly you get liquidity in those things. Investors traditionally, if they put money into a startup, they might have to wait 3, 5, 7 years before they had any chance of liquidity at all. And today, the first time you get a listing on an exchange like Binance, it's happy days for investors, even if that valuation is not very good compared with where you got in. It's still liquidity, and that's always a good thing for a project, I think. The other problem with the ICO space is that this last column, the sorts of investors that we're seeing in the ICO space are very similar. It's very narrowly focused, sort of crypto nuts and digital asset evangelists and so forth. So they're all investing in pretty much the same way, which means lots of the coins are very highly correlated. There's not much dispersion in the general behavior. So the rising tide floats all boats, and when the tide goes out, we've seen most of the tokens between the beginning of the year and now down anything from sort of 60 to 95%. There's plenty of opportunity in the tokenization space in any sort of sector that you look at, whether it's real estate, which Chris mentioned, some of the technology investment, venture capital. All of these things can be tokenized as securities, as effectively asset-backed tokens and so forth. This one is going on right now. It's a security tokenization. It's happening in Delaware, basically, because Delaware will recognize that a token can represent equity in the sense that voting straight into a token, it's on the balance sheet as a real liability. Jersey, you still can't do that because Jersey doesn't recognize the token as being equity. So for Jersey, it's really hard to do a security token right now. These are questions to ask when looking at this sort of market. I don't really have time because I'm moving into the final phase of my presentation to go through all of this stuff. One thing I want to sort of talk about is the way that, to some extent to me, it seems that the asset raising element of some of these projects reminds me a little bit of some of the Victorian capital formation projects in the form of cooperatives or mutual societies, because there's no obvious investor beneficiary. People are buying into these tokens because they believe in them. And it's something Dave has raised before, the idea that you might end up with cryptocurrencies that are sort of localized or keep a community together, but they have an incentive to grow their networks in a different way from a capitalist sort of joint stock company token. This showed you sort of where we stand in the evolution of a sort of variety of these tokens and how sort of relatively immature we are still in the life cycle of utilization. Even though Bitcoin's been around nearly 10 years now and at this point was a $100 billion cap, we're still sort of looking for use cases and extending use cases and using other markets as ways of figuring out whether there are other features that should be adopted by the Bitcoin protocol. It's crazy because, as the first part of this sort of slide says, capital is as easy to come by as it's ever been, and the fact that I get so many of these shitcoin kind of ICO opportunities in my inbox every day, but people are investing in them, and they're figuring out ways of making them look like interesting investments by using bots to spam Telegram channels and so forth. We heard of one project which had raised about 25 million by doing this, and they'd spent 15 million of that on the capital raising process. And then they burned the other 10 hiring really bad programmers, and then they folded. So we kind of, when we want to get involved in these projects, we want to have more involvement, because I think that's the only way that you can guide the formation of the project and make sure that you can create some long-term value in these things. And as the end of this sort of slide says, none of these things have reached the end of their life yet. So nobody has really any game plan for what you do when you've got tons of users that have adopted this technology, and then you've run out of money, and there's still a blockchain kind of floating around with data on it. You just euthanize it or whatever. There's no project management. You can read this at your leisure if you're even considering investing in any kind of shitcoins. Something else that Dave, I think, talks about sometimes in terms of the ideology behind blockchains and the idea that everything has to be decentralized, everything has to be on a blockchain or whatever. None of these are sort of perhaps truly decentralized. At some point, there's always a central authority performing some role. It's just where in the system is that central authority and what role are they performing? But it's interesting to look at the different blockchains in that sort of context. This is the bit that we're sort of uncomfortable with in terms of a lot of these capital raising projects, because if you raise equity, it appears on your balance sheet as equity. If you raise debt, it appears on your balance sheet as debt. If you raise money from these tokens, it just looks like income, and there's no liability, there's no accountability. This is a problem for the market because it does mean that there's no quality control, and you get lots of naive investors kind of suckered in to doing stuff. And then there's no accountability for what to do with the money afterwards. And indeed, it seems like most of the ICOs in that sort of context just think they can go away and spend the money exactly how they please. Yeah, again, just engineering practices in the blockchain space, terrible. Typical shitcoin waterfall, a few people get in early, they eventually persuade an exchange or two to list the thing. The early investors get out, and we're seeing this at the moment in hundreds and hundreds of coins, down 97% from, and there'll still be a few people out there that are hoping that it's going to recover. And yet, overall, ICO performance has still been staggeringly good compared with anything else. The problem for that is that it kind of tarnishes the reputation of the whole space. So every time you get 10 shitcoins that raise money, they sort of dilute that appetite, because not everybody on the planet yet wants to invest in tokenized offerings. And so all of that money is sucking out capital raising potential from really serious projects when it's very hard for end investors to differentiate. Just finishing up with a few challenges for Jersey. I'm a little bit obsessed with this whole thing, but I asked a few people about Jersey as a jurisdiction, and the concept of gatekeepers came up quite a bit. The idea that people are sort of in charge. In technology, it's a little bit more generally anarchic than that. And one comment I had was when there's fear and the idea of gatekeepers, the chances of coming up with a winning formula drop from 1 in 10 to 1 in 500. So we really need to work on this. This is one example. We were very close to Ben in the back of the room here worked on this app. It's a ride-sharing app. It's very uncontroversial in most countries in the world. In Jersey, the police were basically threatening to write to your insurer and tell them that you were performing illegal taxi operations. That's just not the right way to innovate. Here's another example, the innovation review. I'm at 0, but I'm going to carry on because I'm a rebel. The innovation review, there was a website, it monitored all of the recommendations in red, amber, green, and then the website was quietly taken offline, so nobody has any idea whether any of these things were ever achieved, what the status of them was. There's no accountability, no evidence, no lessons learned. That's not how you run any kind of technology project anywhere else in the world. And this is one that came up with Tony the other day. The Jersey taxi drivers released their own app. And a few people commented on their Facebook site, asked perfectly legitimate questions about the app. And so the response from the Taxi Drivers Association was to delete all the questions and block them. Again, that's not how you build good technology. And then this one's a little bit closer to home. I have been trying to start a tokenized philanthropic institution. I was hoping to do it in Jersey, but I don't think it's going to be possible. Turns out that Green Shield stamps or co-op stamps here, which are basically money, they're a token, right? I mean, you can go into a shop and you can spend them, the co-op. But requiring a tokenized receipt for a charitable donation, Jersey decided that needed regulation. So you can drop 500 quid in the Red Cross tin. You can buy these Green Shield stamps or get them as a reward without any form of regulation. But to receive a tokenized receipt for a charitable endeavor is apparently the sort of thing that Jersey doesn't want to do. Thanks. Great stuff. All right.